Today, we're going to examine a technique for valuing put options known as put-call parity. Call and put options written on the same stock with the same expiration date and the same exercise price are related by an equation known as put-call parity. The derivation of the equation uses an arbitrage proof. We will build two portfolios and show that their future payoffs are identical. If the future payoffs are identical, then the current values of the two must also be the same. If not, everyone would buy the cheap portfolio and short sell the expensive portfolio until the prices were equal. Consider two portfolios. The first portfolio we will call A. To create portfolio A, we buy a share of stock and we buy a put option on that stock. The value of the stock today is S sub 0, and the value of the put option today is P sub 0. We will start by examining the value of the portfolio if, at expiration, the stock price is less than or equal to the exercise price. Over here, we're examining our values at expiration. There are two possible outcomes. Either the stock price is low, below the exercise price, or the stock price is high, above the exercise price. We'll start by examining the scenario on the left, where we have a low stock price at the expiration of our option contract. We begin by examining the value of the stock on the expiration day of the put option. We'll start by looking at the scenario where the stock price is lower than the exercise price. In this case, our stock is simply worth S sub t on that date. The value of the stock is not dependent on the exercise price of the option. Now we examine the value of the put option at expiration if the stock price is lower than X. We know that put options are in the money when the stock price is lower than the exercise price, and so at expiration, the put option will be worth its intrinsic value, X minus S sub t. The option is at expiration, and so it has no time value. Only intrinsic value remains. We can now examine the value of the stock and the put at the option's expiration when the stock price is below the exercise price. We have a share of stock, it's worth S sub t, and we own a put option with value X minus S sub t. We add the two values together to get the value of our portfolio. The S's will cancel and we're merely left with X. So the value of portfolio A at expiration, if the stock price has fallen below X, is simply equal to X dollars. Next, we're going to examine the value of portfolio A if at expiration the stock price is now greater than the exercise price on the put option. We start by looking at the value of the share of stock. At expiration, it's simply worth S sub t, regardless of whether or not that is higher or lower than the exercise price on the option. Next, we examine the value of our put option if at expiration the stock price is higher than X. We know in this case that our put option expires out of the money, and so it will have no value. Finally, we can add together the value of the stock and the put if at expiration the stock price is greater than the exercise price. The stock is worth S sub t, the put is worth 0, and so the portfolio is the sum of those two, S sub t. To recap, portfolio A consists of a share of stock and a put option. We examine the value of these assets at the expiration day of the option contract. If the stock price has fallen below the exercise price, then the portfolio is worth X dollars. If the stock has risen above the exercise price, the portfolio is worth S sub t dollars. Next, we'll examine portfolio B. To create portfolio B, we buy a call option on the same stock as in portfolio A, and we buy a pure discount bond that matures on day T with a face value equal to X. The present value of the bond is XE to the minus RT. Note, here we're using continuously compounded interest. It says the present value of a future cash flow is that cash flow times e to the minus RT. Let's examine this bond concept for Portfolio B a little more closely. But before we do, let's go back up to Portfolio A and remember what we had here. We have a put option. A put option is the right to sell a share of stock. So in order to exercise a put, I need to own a share of stock, and that's why we've included the share of stock into this portfolio. Now, let's go back down and have a look at Portfolio B. Portfolio B has a call option. In order to exercise a call, you need cash. How much cash do I need? I need X dollars in the future, but I don't need X dollars today. I need the present value of X today. It will earn interest over its life and turn into X dollars at maturity. We have called the second asset in Portfolio B a bond, but it doesn't need to be. It can be any interest-bearing type of security. Let's look at a timeline here. Today is time 0. The option matures out here or expires on day T. We know that to exercise, we need X dollars, but not today, on day T. And so we can buy a bond with a face value of X. So it's not worth X dollars today, not at time 0. Instead, it will be worth X dollars out here when it matures. And so the present value of that bond then, the price of the bond today, is X times e to the minus RT. We can also think of this as simply a savings account at our bank. If we deposit this much money today, it will earn interest and we'll have X dollars at maturity. Or we can think of it a pure discount bond. This is the price we pay for the bond today. The bond will earn interest and be worth X dollars at maturity. So that's why we have a bond in addition to our call option. The call option is what we want to exercise, and the bond provides us with the cash needed to carry out that exercise. For Portfolio B, we start by examining the portfolio value if, at expiration, the stock price is less than or equal to the exercise price. Recall again we have a call and a bond. There is no stock in this example, but there will be a stock price because there's a call option. So we look to see if the stock price is less than or equal to the exercise price on the call on the day the call option expires. If the stock price is less than the exercise price, the call expires out of the money and is worthless. So for Portfolio B, the call option has 0 value at expiration if the stock price is less than or equal to the exercise price. Portfolio B also contains a bond. The bond is worth its face value at expiration regardless of the stock price. Recall that we bought a bond just such that its maturity value would be equal to the exercise price of the call. So, if the stock price is less than or equal to the exercise price, the bond is still worth X dollars, its face value at maturity. So, when the stock price is low at the end of our holding period, Portfolio A is worth $0 on the call and X dollars on the bond. So the portfolio itself is worth X. When the stock price is low, we have a call worth 0, a bond worth X, and so the portfolio is worth X dollars. Now we look at Portfolio B if at expiration the stock price is greater than the exercise price on the option. This scenario here on the right. If the stock price is greater than the exercise price, we know the call option is in the money. At expiration, call options have no time value, only intrinsic value. and so the value of the call must be its intrinsic value, which is the ending stock price minus the exercise price. So again, we're looking at the call, its value at expiration when the stock price is above X. Our call option is worth its intrinsic value, S sub t minus X. The bond, on the other hand, is worth its face value regardless of the stock price at expiration. So again, portfolio B, the bond, when we bought the bond, its purchase price was XE to the minus RT. Over time, that bond earned interest, and at expiration, its face value is X dollars. So, when the stock price is greater than the exercise price, the total value of portfolio B is, the option is worth ST minus X, the bond is worth X, and so the total portfolio is worth S sub t. Again, we see those numbers here. If at expiration the stock price is higher than the exercise price, our call is in the money and worth S sub t minus X. The bond has matured and will pay off its face value of X dollars, and so the X's will cancel, and we're left with S sub t for the value of portfolio B. So note that when the stock price is less than X at expiration, the value of portfolio A is equal to the value of portfolio B. We're in the left-hand column here. If at expiration the stock price is lower than the exercise price, portfolio A is worth exactly X dollars, and portfolio B is worth exactly X dollars. So A and B have identical values if the stock price falls at expiration. Now we'll look at the scenario where the stock price rises above X. Again, we see that the value of portfolio A is equal to the value of portfolio B. So here we're in the right-hand column where the stock price is greater than the exercise price. Portfolio A is worth exactly S sub t dollars. Portfolio B is also worth exactly S sub t dollars. So they have identical values at maturity or expiration, regardless of what happens to the stock price. So regardless of whether the stock price falls below X or rises above X, the value of portfolio A is always equal to the value of portfolio B. At low stock prices, both portfolios are worth X dollars, and at high stock prices, both portfolios are worth exactly S sub t dollars. So portfolio A has an identical ending value to portfolio B under all possible outcomes. Note that no matter what happens to the stock price, both portfolios have exactly the same payoff at expiration. So they must have the same value today. If not, there would be an arbitrage opportunity. We would buy the less expensive portfolio and short sell the more expensive portfolio. Market forces would drive the two current values to be equal. We've shown that the future value of portfolio A is always equal to the future value of portfolio B, and therefore argued that the current or present values of the two must be the same. We can set the value of portfolio A equal to the value of portfolio B. Recall that portfolio A consisted of a share of stock and a put option. Portfolio B consisted of a call option and a bond whose present value is equal to XE to the minus RT. We'll set the two equal and solve for the put option value. When we solve for the put option value, we have the put-call parity relationship. It says the value of a put option is the value of a call minus the stock price plus the present value of the exercise price. This concludes our examination of put-call parity.